needs no introduction. He's the CRO of the country's third largest private bank. And I'm really happy to have you here. So today the topic was more to discuss on few of the key pillars that we think is shaping the industry right now. But before I can get into the finer details, let me ask you, in the last decade or so, how do you think the consumer behavior or the attitude towards the consumer in credit has changed or evolved? I mean, you can talk about salaried or self-employed. You can talk about rural, urban population. How are they shaping up right now in terms of the behavior?
Okay. First of all, thank you, Ram, and thank you, CRIF, for inviting me and to be in the on this on this forum. So a very easy question to answer because things have changed dramatically. I think every single individual, whatever strata of society today, looks at their repayment behavior, looks at their score, and looks at how the bureau view them. And to that extent, it's a sea change in terms of approach and attitude as well. So that's one. Second, you do have to keep in mind it's not just the urban population which was very credit conscious in a sense to ensure repayment behavior, but over the last 10 to 12 years, if you've seen, you have had a large number of customers in terms of just the sheer population size from the MFI world, gold loans, consumer durables, your entire mobile financing world, just the sheer population which has entered what I call the credit stream has increased. And they are becoming very credit conscious. So, to that extent, if we were to go back 15 years or 10 years ago, you probably did not have a situation where somebody was looking at their repayments, but today, every single individual person, salaried, self-employed, high net worth, first-time credit, is looking at repayment, looking at the bureau, and looking at how do they score because they are really wanting to probably have a lifestyle for which they are looking at lending opportunities. They're looking at credit cards. They're looking at consumer finance. Some of them are looking at affordable housing. Of course, at the upper end of the stream, you also have vehicles and home loans. So every strata of society, you're seeing customer behavior change, and correspondingly, the way you approach lenders, the way you approach your credit has also changed, undergone a sea change over the last few years, and only picked up, I guess, exponentially in the last, let's say, 5 to 7 years.
Right.
Really.
Yeah, I think I would tend to agree with you on this in terms of consumer awareness. It's really increased, and our data also shows the penetration of credit beyond the top 100 cities now is beating the penetration of credit in the top 8 cities. So traditionally, that shift has happened, and I agree. A lot of new to credit population has come to the mainstream population here. Now, this is the right forum to ask this question. A lot of digitization and transformation happening across various sectors, and the play of fintech as well. While there is a lot of opportunity in doing that, there is also risk, increased level of risk in terms of cybersecurity, data protection, all those things, right? So, how do you view this? How do you calibrate this risk and opportunities at Axis Bank? Anyway.
First of all, it's a fine balance. There is no doubting the fact that there is huge potential. There is an opportunity for banks to grab, whether it is grabbing market share from some of the other lenders or in general trying to grab market share from the underserved in that sense. So there's a huge opportunity. There is a fine balance to the risk appetite that you probably have. Each organization has their own risk appetite, but they're chasing it in their own risk calibrated manner. So I don't see any reason why banks don't chase that opportunity. Now, coming to where the divide, obviously, I think there is, at least there seems to be earlier some amount of saturation in the tier 1, tier 2 cities. Lot of players in the market. You now have fintechs, NBFCs. So everybody's probably chasing similar kind of customers, and which is why you're seeing expansion of both branches and digitally, approach to customers. So the way customers are getting approached both by the traditional lenders and the fintechs is ensuring that the speed of response needs to be far faster. And because of which there is this whole digitization which has come about. And today, I mean, there are platforms like Account Aggregator, for example, where you can get access to information access to bank statements, besides your traditional, credit documents that you would probably ask
Right.
for from the borrower. All of that has changed the way, let's say, lenders look at credit decisioning. They look at different platforms to do credit decisioning. So that's changed quite a bit. Now, automatically, what that means is you have the increased risk of operations risk and cyber risk, because you
Absolutely.
suddenly are now being exposed to APIs with fintechs, partners,
That's it.
partnerships. In the rural markets, you also have the CSCs where you are, and BCs that you really partner with. Again, you're exposing your ecosystem to a whole host of risks there.
Absolutely.
And to that extent, banks and institutions need to be very, very careful in terms of what they do. So clearly, there is a change in the way lenders approach these customers, but there's also a change in the way customers are looking at getting served at their doorstep. And that does not mean it's only tier one, it's reached tier four as well. Large banks have presence now. I mean, for example, we have a presence in 6,000, branches all across the country. Some of our peers have large presence as well. So even the large traditional banks have now going to the last mile,
Right.
if I may call it that.
Right.
Earlier, it used to be the NBFCs which were really catering to that segment.
Correct.
So you have large banks, you have NBFCs, and then you have the fintech, which is catering it in the whole digital world. So you're seeing all of that getting captured as an ecosystem from a lender's point of view. And yes, you're right. The increase in the exposure to these fintechs, to these APIs, is only increasing the cyber risk.
Right. So that's a leading question for me. So, see, if you look at the fintech ecosystem altogether, you have the traditional banks on one side who are also transforming digitally, and then you have the hardcore fintechs on the other side who are digitally really very savvy, and then you have the NBFC fintechs who do it. Do you see them in some places? I know you collaborate with them for co-lending and all those things. In some places, they're competing with you in the same space that you have. So how do you see this going forward? Will they be more of competitors or partners to you in business growth? And in which areas do you think they'll collaborate with?
See, there's a lot of collab. See, I think there is no denying the fact that the fintechs are nimble. Their user experience to a large extent is, attracting, let's say, a population which, for some reason, the banks are slow in attracting.
Okay.
But yeah, we are also moving the needle faster in that sense, but not at the pace that Gen Z is expecting, or the way the fintechs are doing. So there is a huge market that exists where the fintechs have created a niche. There's no denying that at all. And the strange part of it is there's no reason why banks like us can't be doing the same thing. But somehow, we probably are doing catch up there to a large extent, and which is where those partnerships come in. I think the nimble, approach that the fintechs have with the distribution strength that a bank like ours has, if we combine the two, then that's really powerful. It allows us to reach far more customers in a seamless manner. It allows partnerships which give us a lot more customers to cross sell along the way. So there is partnership which is clearly visible. It's there. We do have partnerships, for example, on the e-commerce side. We have partnerships with telcos, for example. We have partnerships with large internet players. So all of that means that there is an ecosystem which can coexist. There is no two ways in our minds. But yes, if I look at it, where are the fintechs scoring? Probably speed and user interface. The look and feel of what the Gen Z is looking for, probably something. And as we go along, we ourselves have invested a whole host of done investments in mobile banking, in digital. Our mobile app, for example, is rated one of the highest in the world. But all of that is basically, in a sense, still doing catch up, right? To look at how can we cater to that entire audience. But our own assessment there is obviously that there is collaboration there. There's no way, two ways in our mind that at some point there could be competition, but I guess we're too large enough for them to be considered competition in that sense. But there is a play for both, and there is an ecosystem that can coexist. I think the other advantage that to some extent they had was this whole regulatory arbitrage, which is obviously now disappearing, right? So there is a level playing field there. Increasingly, all of them are coming under the regulatory umbrella. So there is what I call the right equilibrium there. So to that extent, the collaboration does help if you have strong regulations which govern, the ecosystem.
See, with all the risk calibration that has happened over the period, I think banks, we were there yesterday as well, how the portfolio quality has improved over a period of time. But I think the ability to buy risk on new to credit customers, that's slightly fading out. It could be an interim phenomenon. I am not sure if it is a permanent thing. But across we're seeing that is fading, whether it's MFI sector, consumer, the commercial sector, that's kind of fading. So how at Axis Bank are you viewing it? Do you want to continue growing in the NTC segment? And how do you, is there any different methods of evaluating than that we do?
See, I think the way we have to look at it is that it depends from product to product, right? Our stated strategy for some of the products is that we will focus on existing to bank, right? So let's say, for example, in the unsecured space, which is let's say credit cards or personal loans, we still have a very large population which is existing to bank. There is a large population of existing customers which we still need to mine for unsecured. Does that mean that we will not be doing NTC? No. Clearly, we do. If we believe there is opportunity, we will look at it, but in a risk calibrated manner. Home loans, you largely see people who borrowed before. So to that extent, NTC is very small population. At best, you may have it in the affordable housing segment, etc. But largely, you see them, customers who've been credit tested in a sense. On the self-employed side, whether it is business loans or the large corporates, SME, you typically see most of them would be credit tested customers. So that's another segment which is credit tested. Now, if you go down that value chain, the only two products where you see still large populations of NTC is
Two-wheelers and CD.
and microfinance.
Second.
Now, there again, I mean, you've gone through your cycles on microfinance. We keep going through those cycles from time to time.
Correct.
Every time we believe that everything is normal, one new state comes up, or a flood comes up, or an event comes up. I don't think we've seen stability there still, especially in the industry on microfinance. I would like to believe there is still some amount of stability still left, for it to be demonstrated. And hence, the focus is still existing to book, existing customers, etc. But as you go along, your new white spaces are still going to be underserved NTC customers.
Absolutely.
And the other segment, which I personally believe is a large white space, is you have a large population, like I mentioned, of the gold loans, consumer durables, and personal MFI gold loans and consumer durables, which is your mobile financing segment. For them to get migrated to full-fledged PL or BL or a vehicle loan, you don't have enough information, whether it's on the salaried side or the self-employed side. So, because you don't have that information, the ability for someone to underwrite those is a challenge.
Right.
And hence, that space is what I would like to believe probably is going to see a large demand coming in, because now they've migrated beyond the normal MFI,
Correct.
are looking for the higher loan or looking for the vehicle or looking for a home loan, which is in the affordable category. And the ability to underwrite is going to remain not only a challenge, but also an opportunity for banks, is how I see it. So NTC will still remain a large segment, but for larger banks, it probably is a smaller segment.
Okay. And it's also product.
It's product driven, yes.
I would agree with you on the MFI side. In fact, the portfolio is shrinking. It's contracting quarter on quarter on the MFI side. And I'm only wondering, with the guardrails on, and if you don't go to NTC, where are you going to find new customers? So I think it's a very vulnerable segment also, right? So that is one. When you spoke about product specific, because each product carries a different type of a risk, how would you view? I mean, I'm generally coming to hear from some of the bankers, they would like to look at a customer level risk and not a product level risk. But we at CRIF believes there is also a product level risk, given the hierarchical behavior of repayment, right? So customer may not repay all the loans with the same integrity. Given that, what is your view? Would you like to look at a product level risk for a customer, or just a customer level risk, and you can give him any kind of
So two things. One, there is what the regulations tell you, and two is what the credit risk tells you. Credit risk tells you look at the customer first. Intent is most important. Whether you're doing a home loan or a consumer durable, it's a customer risk at the end of the day. I doubt if banks are lending basis the fact that I will repossess and make my money. No chance, right? You're basically looking at credentials of the customer to start with, independent of the product, and then the product nuances come to add to the customer nuance. So whether it is LTV for home loans or the type of vehicle in a a vehicle loan, or again an LTV there, all of those come into play. But primarily, you need to have a look at the customer first. Second, the regulation is very clear, right? One loan default is all loan default. So to that extent, if you don't look at the customer and try and do the product route, it's not going to help you, because if you start chasing large number of such customers, you're likely to have a default at some point of time. And if the smallest known defaults is as good as the largest known defaulting. So to that extent, I would still think a customer one view is most important. And the way I look at it is that increasingly customers are also getting attuned to the fact that the bank is underwriting the customer first and then the product later.
Right. So that's a good way to look at it. You're saying underlying customer level risk is integral, and then for nuanced views, you can look at the product level risk. The two, three more questions. I won't hold you for long, but I'm very curious about this digitization in the MSME space. Now, the country's largest bank, SBI, is now underwriting up to 5 crores digitally. I mean, it's not the digital disbursements, but at least credit approval is there digitally in few seconds. We've seen this happening heavily on the consumer side of the business, right? It's really one-click loans available right now. Do you see that as a roadmap for access of the industry where the MSME space, at least the micro, which is more voluminous and high velocity loans, getting into this rub-off effect?
See, you're right. In the sense, I think we're gradually getting there. But you do need to keep in mind the nuances between the two, which is to say, in the salaried world, we do get information which is verifiable. There are multiple sources where I can verify that same information.
Correct.
In the self-employed world, it's not as easy. There is a lot of declaration on the basis of which you do. There is a lot of nuances to the credit underwriting that you do. And most importantly, more than the financials, really you're looking at the bank statements.
Correct.
And you're looking at GST and you're looking at sales, which are very different and nuanced. Now, unless all of that is digitally woven in, it is difficult to underwrite those customers. Does not mean that we don't do it, we do it, but for smaller ticket sizes. The moment you go larger ticket sizes, the ability to underwrite such large tickets with only such information is a challenge.
Right.
And I've always believed, over a certain loan amount, you genuinely need to go back and check whether the customer exists or not. There are some basic checks. I think in this whole digitization world, I don't think we should go behind, in terms of the first principles of credit.
Right.
And for all the analytics that we have kind of invented and reinvented now with AI also, the basics of credit has never changed.
Right.
Income, obligations, and let's say in salary in nature, and type of employer, in self-employed, nature of business and banking. I don't think that fundamental has ever changed. So to that extent, all of this ensures that you need some information, you need some documentation, and most importantly, you need to be verifying both of these. Now, if that can be integrated into a one app or a one-stop ecosystem, then you're right. The ability for banks to underwrite that is going to increase. And you've seen, you have examples where this is increasing. I mentioned GST, for example. There is account aggregator where we get this information. So the moment we start accumulating a lot of this information, a lot of what was unknown earlier or unverifiable earlier is now becoming verifiable for us to take that decision. But yeah, a 5 crore loan without human intervention, in my mind, is still some time away.
Right. Yeah, so the touch and feel is here to stay in the near term, at least for loans beyond a particular loan size. So, Amit, if you can take a few minutes to engage the audience on what keeps you awake at night when you think about the next big transformation at Axis Bank.
So first and foremost, I sleep well. Let me assure you, it's also largely due to a very brilliant team that I have. And most importantly, I think we've built a framework which I would like to believe is strong. Yes, there are fires all the time,
Right.
and there are people who can douse that fire also most of the time. So as long as you have built an ecosystem which you'd like to believe is good, then yes. But honestly, other risks are easier to manage, or you know how to respond. But if there's one thing which is the most difficult, and like my CISO keeps saying, the unknown unknown, it is cyber risk, because you don't know how and in what form that will hit you.
And when.
And that's really the only one where I would like to believe, you probably need to invest a lot more as an organization. Obviously, Axis has invested heavily, but just that if you hear and see what's happening in the ecosystem, that's one risk which I would like to believe we still are getting and grappling and getting our arms around as an industry, not just as a bank.
No, I think it's true. With the wake of digitization and other things, that's a common threat. One last question, maybe. So, so Amit, there are a lot of Gen Zs, new generation credit risk professionals coming into the industry, and they view to credit maybe very different, risk maybe very different to what we used to have 20 years ago, right? Albeit the fundamentals have not changed, that the view, how they look at it is very different. What would be your one piece of advice? So somebody who is aspiring to enter into the credit risk space.
So first and foremost, there is a feeling that people in credit risk or audit and compliance or assurance functions are what I would call pessimistic people, or look at things in a very negative way, etc. It's far from the truth.
Right.
You need to be very optimistic. If you don't know how business can be run, you don't know how risk can be evaluated. So the first thing is you need to be a big optimist to even look at credit and risk as a role.
Right.
I think that's the first thing that I would say. Second is, I think at least in the financial services world, the regulator is extremely strong, prudent, and proactive, which is ensuring that banks are kept on their toes, which means businesses are also kept on their toes. So you need what I call conscience keepers.
Right.
And the assurance functions to a large extent, work as conscience keepers. And my advice would be that if you believe you are the conscience keeper, then you have a role
Right.
in the banking ecosystem, and a very powerful role as a credit risk person. And the good part is, people look at risk as just one function, but I look at risk as multiple areas of, so if I go back 10 or 15 years ago, when somebody talked of risk, they just looked at credit risk, market risk, and liquidity risk. Today, you have digital risk, fraud risk, information security risk, cyber risk, ESG risk, climate risk.
Right.
So the nuances of risk have also grown manifold. So to that extent, careers and so have actually expanded quite a bit from the traditional risk careers or credit risk careers that were there earlier. So yeah, remain optimistic, and like I say, the regulator will ensure you have a voice.
Remain optimistic, credit risk professionals, and I think it's music to the business guys to hear this. It was very nice talking to you, Amit, and thanks once again.
Thank
It's a
you very much.
pleasure having you here.
Thank you very much.